Imagine you're at this restaurant, right? And it is known worldwide for its pizza.
Okay, I'm with you.
The lines are just totally at the door. The ovens are firing. The brand is iconic. It's the place to be.
Right. A total cash cow.
Exactly. But then one day, the owner walks in, takes every single dollar out of the cash register, pulls from all the future profits, and just decides to build a commercial spaceship in the alley out back.
Wow.
I mean, it's an incredible, awe-inspiring scientific endeavor, obviously, but the investors who are sitting at the tables eating their pizza are suddenly looking around, looking at the balance sheet and asking, wait, where is the food? We sell pizza here.
Yeah, they're panicking.
Exactly. And today, that is the exact identity crisis we're unpacking. Welcome to today's deep dive, everyone. We are looking at a massive $1.5 trillion company.
Which is just a staggering valuation.
It really is. We're talking about Tesla. And our mission for you today is to explore this gargantuan $25 billion bet they're making on a future that honestly has absolutely nothing to do with traditional steering wheels.
Yeah. And we're essentially watching a legacy manufacturing company attempt to rewrite its own DNA in real time, which is, incredibly risky.
Right, because making cars is supposed to be somewhat predictable.
Exactly. For decades, the automotive business model has been super comforting. You bring raw materials in stamped metal, lithium rubber, and you send a finished vehicle out the door.
And physically see it.
Right. You can walk onto a factory floor, point to an assembly line, and literally watch your capital turn into a product. But pivoting tens of billions of dollars toward artificial intelligence and robotics, well, it completely abandons that physical comfort zone.
It's all digital now.
Yeah, it takes a company that built its empire in the physical world and throws it into this highly speculative, highly invisible digital frontier.
Okay, so let's unpack this pivot, because to understand the friction happening on Wall Street right now, we have to look at exactly where CEO Elon Musk is directing this massive influx of cash. The new spending plan he's pushing scales up to over $25 billion, and the bulk of this capital is earmarked for artificial intelligence, robotics, and computer chips.
Massive, massive investments.
Yeah. During a recent earnings call, Musk actually outlined a $2 billion investment for the year ahead allocated solely for AI software and chips. $2 billion. Just for chips.
Yeah, and the scale of that expenditure requires a massive shift in infrastructure. I mean, when a normal automaker invests $2 billion in its core business, it usually means building a new gigafactory, right? Or designing a new chassis.
Or securing a lithium supply chain, something like that?
Exactly. But spending $2 billion on AI chips, that means buying tens of thousands of highly specialized GPUs, building massive server farms, and paying for the literal gigawatts of electricity required to cool them all down.
That's a whole different business model.
Completely. They are building supercomputers to train neural networks. They're pouring capital into the digital brain that will, eventually power their autonomous driving software and their humanoid robot, Optimus.
And Musk is incredibly confident about this. He told investors that the spending is, quote, well justified, and that it's going to pay off in a very big way by establishing massive future revenue streams.
Which is a huge promise.
It is. But the market reaction tells a much more complicated story. According to the BBC report we're looking at, shares initially saw a bump, but then they fell in after-hours trading.
Right, because of the timeline?
Exactly. The tension really comes down to a massive monetization gap. The $25 billion is flowing out to build the spaceship, to use our analogy, but the revenue from that specific spaceship isn't flowing in yet.
Well, yeah, because Tesla has effectively entered an industry-wide arms race alongside major U.S. tech companies.
Yeah.
You've got Microsoft, Google, Meta. All of them are throwing billions at AI.
Right.
The problem, and the reason Wall Street gets so jittery here, is the timeline for return on investment. Turning computing power into a reliable, sellable consumer product is notoriously difficult.
Right, because you can't just go buy the robot right now.
No, not at all. The Optimus robot it's a marvel of engineering, but it's not available for the public to purchase. And the vision for a fleet of robotaxis, it's revolutionary, sure, but it remains entirely unmonetized at this stage.
So they are essentially building the most expensive foundation in corporate history, but the bridge to actual consumer revenue hasn't been built yet.
Right.
And investors are basically being asked to suspend their desire for quarterly profits and just, trust this very long-term, highly speculative vision.
Which is a tough sell for Wall Street.
Exactly. But funding a $25 billion sci-fi future means you need a massive hyper-reliable cash flow today, and that brings a very harsh magnifying glass down onto the factory floor.
The core business.
Yes. Tesla's core engine, the actual manufacturing and selling of electric vehicles, is currently losing ground.
Yeah, the global landscape for electric vehicles has shifted dramatically. The physical reality of the car market is now actively clashing with Tesla's futuristic vision.
Because of the competition.
Exactly. Look at the international competition, specifically China's BYD. They are capturing massive global market share at a really rapid pace.
And they're doing that by offering just a ton of different options, right?
Yes. They are flooding the zone with a staggering variety of vehicles at incredibly aggressive price points. They're offering everything from ultra-cheap microcars for dense urban environments all the way up to luxury SUVs.
Meanwhile, Tesla's lineup is moving in the exact opposite direction. The market analysis from Joe McCabe of Auto Forecast Solutions, it paints a pretty stark picture of their current positioning.
It really does.
Tesla is essentially surviving on just 3 models right now. You've got the Model 3, the Model Y, and the Cybertruck.
Right.
And while they maintain a safe foothold in North America, which is largely because steep tariffs currently keep Chinese EVs out of the U.S. market, they are facing brutal headwinds and heavy competition in Europe and Asia.
And we're seeing that in the numbers.
Yeah, production-wise, it was recently their second worst quarter in the last 2 years. But, okay, here's where it gets really interesting, and I actually have to push back a little bit on the idea that having a narrow 3-model lineup is an automatic disaster.
Okay, let's hear it.
Let's look at Apple. I mean, Apple is arguably the most successful corporation in human history, and they basically survive by releasing 1 or 2 flagship iPhone designs a year.
Sure.
They don't manufacture 30 different shapes of phones to capture market share. They dictate the design, and the world just adapts to it. So why is a 3-model lineup a brilliant strategy for a tech company, but a critical vulnerability for a car company?
It's a great question, but the comparison to consumer electronics really breaks down when you analyze how humans interact with the product.
Okay, how so?
Well, a smartphone goes in your pocket. Its physical footprint is mostly irrelevant to its primary function. A corporate executive, a college student, and a retired grandfather can all derive the exact same utility from the exact same glass rectangle.
Right, that makes sense.
Furthermore, Apple benefits from extreme software lock-in. Once your photos, your messages, your apps are all in the iOS ecosystem, switching to an Android is a massive headache.
Oh, totally. No one wants green text bubbles.
Exactly. But a car is an entirely different beast. It is a massive lifestyle utility.
Yeah, it's the exact opposite of a pocket-sized screen.
Right. A family of 6 physically cannot function with a compact sedan like the Model 3. A plumbing contractor cannot load PVC pipes and heavy machinery into a luxury crossover like the Model Y.
So they need the variety.
Yes. Consumers demand diverse form factors because their daily physical lives demand them. And unlike a smartphone, the switching costs are practically zero.
Oh, that's true. You just buy a different car.
Right. If a Tesla doesn't fit your growing family, there's literally nothing stopping you from driving across the street and buying a 3-row electric SUV from Kia or Ford. Auto consumers need fresh volume and distinct shapes.
Which brings us to the Cybertruck, the third pillar of that lineup. It was supposed to be the great disruptor, but the BBC report's market analysis shows it is losing favor precisely because it is a highly polarizing product.
Yeah, it's definitely not for everyone.
No, it is not a universal crowd pleaser like, say, the Ford F-150.
The Cybertruck is actually a perfect example of design philosophy creating a manufacturing bottleneck. Betting on an unpainted, thick, stainless steel exoskeleton with those sharp, polygonal angles that wasn't just an aesthetic choice, it was an incredibly risky manufacturing choice.
Because of the materials.
Exactly. Stainless steel is notoriously difficult to stamp, bend, and scale in mass production compared to traditional aluminum or lightweight steel.
Right.
So you have a vehicle that appeals to a very specific niche aesthetic, but it fundamentally alienates the traditional fleet buyer, the construction companies and general contractors who buy trucks in bulk based on pure utility and ease of repair.
Wow. So you have a shrinking production volume resting on a highly polarizing design right at the exact moment the company needs maximum cash flow to fund a massive pivot into AI.
It's a precarious spot.
But looking at the financials, there's a fascinating paradox here. Because even though their vehicle production had its second worst quarter in 2 years, Tesla still posted a year-over-year increase in profits.
Yeah, the math seems a bit broken there.
It doesn't seem to work at all until you uncover this hidden revenue stream that has been quietly propping up the balance sheet for years. Carbon credits.
Ah, yes. This is one of the most brilliant and honestly least understood pieces of Tesla's historical financial architecture.
Right. So break that down for us.
Well, to understand why this matters, you have to look at government regulations.
Yeah.
In various global markets, including the U.S., governments require automakers to sell a certain percentage of zero-emission vehicles.
Okay.
If a legacy automaker, let's say a company that primarily sells gas-guzzling trucks and SUVs, if they fail to meet that quota, they are hit with massive punitive fines.
But they have an out, right?
Yes. The regulations allow them to buy what are called regulatory credits from a company that has a surplus. And because Tesla only manufactures electric vehicles, every single car they produce generates a credit.
So they have a massive surplus.
Exactly. They essentially print these credits. And when legacy automakers miss their targets, they're forced to knock on Tesla's door and buy those credits to avoid the government fines.
Wow.
For Tesla, this is revenue with a 100% profit margin. It costs them nothing to generate the credit, and they sell it for pure cash. For years, legacy auto manufacturers were effectively subsidizing Tesla's research and development.
That is wild. It's like a startup founder trying to build a risky new company, but they have a massive trust fund paying their rent every month.
That's a great way to put it.
It allows them to take huge swings without worrying about the immediate bottom line. I mean, in the past, Tesla was pulling in up to $600 million a quarter just from selling these credits.
True profit.
Pure profit. But that trust fund is starting to dry up. This past quarter, that number shrank significantly to $380 million.
Right. And it's not because the regulatory environment has become more lenient. The industry has simply adapted.
They caught up.
Exactly.
Yep.
Legacy automakers are finally producing their own viable electric vehicles. Ford has the Mustang Mach-E. General Motors has an entire fleet of EVs. European manufacturers are electrifying their lineups.
So they don't need Tesla anymore.
Precisely. Because they are meeting their own government mandates now, they no longer need to buy credits from Tesla.
So the passive income is disappearing. Now, $380 million is still a massive cushion. I mean, most companies would kill for that kind of pure profit.
Oh, absolutely.
But the trajectory is pointing downward. The carbon credit safety net is fraying at the exact moment the massive $25 billion bills for those AI server farms are coming due.
Right. It creates an incredibly vulnerable transition phase. You have the core automotive engine slowing down, the regulatory subsidy shrinking, and the capital expenditure on unproven robotics skyrocketing all at once.
That's a lot of pressure.
It requires flawless execution from leadership to manage that kind of structural tension.
Which means, we cannot evaluate the stability of this corporate pivot without looking at the most visible and unpredictable variable in the entire ecosystem, and that is CEO Elon Musk.
Right.
Let's look at a very specific data point regarding consumer demand from the sources. And just to be clear to you listening, we aren't taking any political sides here. We're just impartially reporting the market analysis from the BBC.
Right, just looking at the number.
Exactly. The report indicates that Tesla's sales have been reeling due to the CEO's highly vocal political presence. His deep involvement in political discourse across the US, the UK, and Germany is having a measurable, direct knock-on effect on the brand's demand curve.
Yeah, and analyst Joe McCabe assessed that the political impact on consumer demand might ultimately be a short-term effect. Markets do have short memories, and quarter over quarter, there has been some stabilization.
Okay, so maybe it bounces back?
Maybe. But analyzing a company's health requires looking at the confluence of all these pressure points. If you take a highly visible, highly polarizing CEO, combine that with a polarizing flagship vehicle like the Cybertruck,
Right.
and then factor in an aging core lineup and a dwindling carbon credit cushion, the structural cracks really begin to compound.
And parallel to all of this pressure, we have the matter of his compensation. Recently, Tesla shareholders approved a record $1 trillion pay package for Musk.
Trillion with a T.
Trillion with a T. But this isn't just a giant check handed over freely. It is entirely conditional. He only unlocks the full package if he hits very specific, pre-agreed financial and operational benchmarks.
Right.
It operates almost like a corporate bounty system,
Huh.
or like a boss battle in a video game. Is it a massive motivator or just a huge distraction when car sales are stumbling?
A bounty system is actually the perfect way to describe it. Tying a massive, record-breaking payout to specific performance metrics is a calculated strategy by the board of directors.
How so?
Well, when you have a CEO who is managing multiple massive companies from rockets to social media platforms and who clearly wants to spend his time building the sci-fi future of artificial intelligence, you have to create a gravitational pullback to the core business.
I see. You have to incentivize him to fix the pizza restaurant before he gets to build the spaceship.
Exactly. The $1 trillion carrot is designed to keep a wandering visionary locked in on the immediate survival goals of the automotive branch. It is a massive financial tether to ensure he executes the pivot flawlessly.
That makes a lot of sense.
But it also highlights the extraordinary risk profile of the company. It paints a picture of a trillion-dollar organization that is overwhelmingly dependent on a single personality to navigate a landscape filled with structural vulnerabilities.
Wow. It really is the ultimate high-stakes tightrope walk. If you are watching the tech space right now, or if you're simply trying to understand how modern market valuations are constructed, Tesla is the defining case study of our time.
There's nothing else quite like it.
No. They are attempting to execute one of the most expensive and ambitious corporate pivots in modern economic history. They're trying to fund a $25 billion future in AI and robotics while walking a very fragile tightrope over an aging car lineup, shrinking passive revenue, and increasingly aggressive global competition.
It really leaves us with a fascinating, lingering question to consider, one that challenges our fundamental understanding of the industry itself.
What's that?
Well, if this massive gamble actually succeeds, if they spend the $25 billion and successfully transition their products into fully autonomous robots and self-driving neural networks, does the very definition of a car company cease to exist?
Oh, wow.
Yeah.
I mean, so what does this all mean for the future of mobility? In a decade, when you walk into a dealership, are you even buying a physical vehicle anymore? Or are you simply purchasing a highly mobile, continuously updating software subscription that just happens to come wrapped in a metal box with 4 wheels? Exactly. If the real value is in the invisible code driving the AI, the stamped metal on the factory floor becomes nothing more than packaging. It's wild to think about.
It really is.
Well, plenty to mull over. Thanks for joining us, and we'll catch you on the next deep dive.